Welcome to the Graduate Financial Education Program presentation on student loans. My name is Kristen Short. I'm a second-year PhD student in the Financial Planning Program, and the whole purpose of the Graduate Financial Education Program is to provide resources to graduate students in an effort to help reduce financial stress that graduate students are facing. So today we're going to be focusing on student loans, and I know this is an area that graduate students experience a lot of stress. So hopefully you can take away some helpful points, and I hope to do kind of a reframe a little bit on student loans to help ease some of the stress that you may be experiencing around this topic. I know a lot of us hear in the media quite often about the student loan crisis and how people are defaulting on their student loans, they're not able to pay them back. And I just want to first of all assure you and comfort you in that graduate students typically are not the ones defaulting on their student loans. Graduate students have a very high repayment rate on their student loans, and oftentimes taking out student loans for graduate school is well worth it in the long run. So just to kind of think about this question a little further and demonstrate with some math how you can assess whether or not student loans are worth it when it comes to graduate school, let's just take a look at some of the salary differences a person might experience going from a bachelor's to a master's degree. So if you look across a variety of fields, biology, business administration, computer science, education, mathematics, psychology, you see kind of that average entry-level salary with the bachelor's degree. And then you see here the average entry-level salary with a master's degree. And then the final column there is just the difference between the two salaries. So, we've got a minimum increase of about $5,400 and then up to as much as $18,000 difference if you're in a field like computer science, for example. So we see that salaries do tend to increase with a master's degree. But how do you evaluate whether or not that increase in salary is worth it if you're having to take out student loans in order to get the degree? So let's walk through a scenario. The estimated cost of attendance for Georgia residents at UGA is about $25,000 a year. What that means is when UGA does its analysis of tuition, fees, housing, room and board, their assessment is that it would cost a person about $25,000 all inclusive to go to grad school for 1 year and cover all of their living expenses. So if you were to take out the full $25,000 per year in student loans for a master's degree, let's assume it's a 2-year master's degree, you would have a total student loan amount of about $50,000. Now let's say the interest rate on that student loan was 6%. On a standard repayment plan, which is the most aggressive student loan repayment plan, you'd have 10 years worth of payments after graduating, and each month your payment would be $550. Your annual total would be $6,600 per year. So looking back at our chart of salary differential between master's and bachelor's degrees, if you had an annual student loan payment of $6,600 for 10 years, but your salary increased by $9,800 or $18,000 or $10,700 or $7,600, any one of those salary increases would be worth making a $6,600 student loan payment, right? It's like someone saying, hey, if you go to grad school, I'll give you $10,000 a year extra on top of your salary. All you have to do is give me $6,000 of it back, right? Anybody would take that deal because it's a net gain of $4,000, right? So as long as your annual student loan payment is less than what the increase in salary is that you anticipate, you could argue that it's worth it economically to take out the student loans in order to get that higher salary. Now, you'll see in some fields like education, the break-even point might not be totally attained with $50,000 worth of student loans and a salary increase of only $5,400 a year. Now, the reason why I don't have an X there, I just have a question mark, is because I still wouldn't say that you should rule out education as being worthwhile for grad school, because number one, there's forgiveness programs that may help alleviate some of the student loan payments that make the master's degree worth it. And number two, even this way of calculating the worthwhile element of student loans, it's really a conservative estimate because you're only going to be making those student loan payments for 10 years. But the increase in salary you experience, you're going to experience all the way until you retire. So even if it's not quite evening out in those 10 years, in the long run, it still may be worth it to have that master's degree with a higher salary. So what about a PhD? Let's just take a look at it. Similar facts as before, except for assuming you're in school for 4 years instead of 2 years. So your total student loan amount is $100,000, and that brings your annual total payments to $13,320. Well, if you look at some of the data in fields such as communications, journalism, education, etc., the average annual increase in salary from a master's to a PhD is $15,000 a year. And in the STEM field, it would be an increase of around $30,000. If you're in professional school, that increase is going to be astronomically higher, right? So an annual student loan payment of $13,000 a year for $100,000 of student loans would still be worth it in either of these profession areas, because the amount of increase you would experience from your salary by getting the PhD would exceed what you'd have to pay back in the student loans. So overall, your net worth would increase by getting the degree, even if you had to take out $100,000 of student loans. All right, so what's the catch here? So the catch is, let's say on this graph, you've got this red line, which was like your old salary if you don't get the degree. And then the blue line is like your new salary if you were to get the degree. And let's say you have 10 years of student loan payments, and the full increase of salary that you experience from getting the degree is all going towards paying off your student loans. Well, the drawback there is, even though you got that bump in salary, you're still having to live at a standard of living that you had prior to getting that bump in salary, right? So you're still having to live as if you had the old salary for 10 years while you work on paying back your student loans. That can be kind of problematic because, especially if you're already delaying some of your other financial goals, that 10 years, you're going to be having to, potentially sacrifice things like retirement savings, paying off other high interest debt, maybe saving for your children's education savings. So that makes you start to wonder, is it still worth it to have to delay these other goals by another 10 years because all of my increase in salary is going towards paying off student loans? So the good news is, if you're in a situation where the full salary increase is going towards paying off student loans, you have some options. Number one, there's various repayment plans. And these repayment plans, what they do is they can kind of spread those payments out over longer than 10 years so that they take up a smaller portion of your income each year. And then that frees up some additional cash in those early years that you can start working towards or accomplishing some of those other financial goals. Not only that, but there's also forgiveness programs out there that, if you look at the graph, could eliminate the last 5 years of payments. After 20 years of making payments, the rest of your balance is forgiven. Or some forgiveness programs where your payments are limited to 10 years, even though you're paying less than the standard repayment plan, and the rest of your balance is forgiven. Right? So then we kind of get back into this place where maybe the student loans actually are worth it again, especially when you can use these repayment plans and forgiveness programs to kind of optimize your financial goals. So a quick note about what's optimal when it comes to paying off student loans. I just want to emphasize that the best advice for one person might be the absolute worst advice for another person when it comes to paying off student loans. There's no single repayment plan that's best for everybody. There's no forgiveness program that's best for everybody. It might be best for one person to keep their loans federal. It might be best for another person to refinance them into private. It just totally depends on your personal financial situation. And so I want to be very careful in providing some caveats to, help guide you as you consider what your best option is. And what I want to say is, if you have an option to enroll in a repayment plan that lowers your monthly payments, picking that pathway will increase the amount that you pay on the loans overall, because by decreasing your monthly payments, you're going to be accumulating more interest on the loan. And in the long run, you're going to have to pay a lot more than if you had just stayed on the standard plan. So it's only worth lowering your monthly payments if it allows you to use the extra money that gets freed up to contribute to other high return investments like saving for retirement, especially if the rate of return you can get on your investments is greater than the interest rate on your student loans. Number two, if having that extra cash by lowering your student loan payment allows you to pay off other high interest debts. So let's say you have a credit card debt that's at 20% and your student loan's at 6%, it would be worth enrolling in a repayment plan that lowers your monthly payment on your student loan so that you can redirect that extra money to paying off your credit card debt. And then number three, it could be worth lowering your monthly payments if it results in loan forgiveness. So if by being on an income-driven repayment plan, for example, it lowers your monthly payment because you're going to qualify for public service loan forgiveness or something like that. And we'll talk a little bit more about that forgiveness program in a little bit. So otherwise, again, it just results in you paying a lot more over time. So if it's just a matter of wanting to lower your monthly payment so that you can get a nicer apartment or so you can get a newer car or so you can eat out more, that's not going to be a good reason to lower those monthly payments. You should just stick with the standard plan and pay it off as aggressively as possible. But if you have some of these other financial goals that are high priority, high interest debt, or saving for retirement, or something like that, then it might be worth lowering your student loan payment in order to free up cash for those financial goals. So let's just talk a little bit briefly about the types of loans. You have federal loans and private loans. Federal loans are those offered and backed by the federal government. Private loans are those loans offered by banks, credit unions, state agencies, from schools specifically. So they're not backed by the federal government. And federal student loans are broken down into a few different types. Federal Family Education Loans, or FFEL loans. Those are expired, so they're no longer being issued. But if you have loans from, maybe 10 years ago, then they may be FFEL loans. Perkins loans are loans directly issued from a school, but that are backed by the Department of Education. Those are also expired, so they're no longer being issued, but you may have some Perkins loans that you received in undergrad potentially. And then direct loans, which are, as of now, the only types of loans that the federal government is issuing. And those are just undergrad, graduate, professional school student loans offered by the Department of Education. Within direct student loans, there's several types. There's Stafford loans, which are kind of the standard student loan, which can be subsidized or unsubsidized. Subsidized student loans means that you're not charged interest during school. Unsubsidized loans means that the interest is accumulating during school. All graduate student loans are unsubsidized student loans. So if you have subsidized loans, they're probably from undergrad. There's not really any chance of getting a loan in grad school that is not accumulating interest. Then there's something called plus loans. This could be like a Parent Plus loan if you're taking out loans for a child, or if you're in graduate school and you need extra money, or professional school, you need extra money beyond Stafford loans, then plus loans come into play to get kind of above the minimum thresholds that Stafford loans allow. Consolidation loans would be once you already have loans and you want to take all the loans that you have and kind of package them all into one new loan. You might get a consolidation loan to kind of collapse all your loans into one. But generally speaking, I would not recommend consolidating your loans, and we'll talk a little bit more about that in a second. But there's a big misconception out there that consolidating your loans makes your payments lower, or like has to be done for enrollment in certain repayment plans, and that's not necessarily true. In fact, consolidating your loans actually prevents you from taking advantage of some debt management strategies. So I would say, as a rule, generally you want to avoid consolidating your loans. So to find out what kind of loans you have, you go to the nslds.ed.gov website, and you'll be able to pull up a chart that shows the history of all of your loans. So you'll see this person has a series of unsubsidized and subsidized loans that they took out over the course of several years. And it looks like in 2014, they consolidated all of those smaller loans into two big loans, a consolidated unsubsidized loan and a consolidated subsidized loan. So again, like I was saying before, a lot of people think that's kind of step one, what you should do when you graduate, but I would say do not do that. And the main reason is that, let's say you're making minimum payments on all your student loans, and then you have extra money that you want to use towards paying off your student loans a little bit faster. You're going to want to be able to direct that extra money to your highest interest rate loan so that you can tackle the loan that's hurting you the most first, and then go to the next highest interest rate, the next highest interest rate, the next highest interest rate. If you consolidate your loans, then all of your interest rates are going to be weighted and averaged together into one new interest rate on the consolidated loan. So any extra money you put towards the loan is just going to be, saving you interest at that weighted average rate. Whereas if you keep them separate, you can prioritize those dollars towards the highest interest rate debt, and you're going to get a better bang for your buck over the long run. If you don't have federal student loans and you have private student loans, they're not going to show up on this chart. So if you want to find information about your private loans, you want to check your credit report. Also, if you're not sure if your loan is private or federal, you can look at the interest rate. And if the interest rate's above like 7%, then you can be pretty confident it's a private loan. And then if you remember having a cosigner on the loan, that's another signal that it's probably a private loan. So the best way to check is to just go to your credit report and see whether or not it's a federal loan with the Department of Education and one of their loan servicers, or if it's with a private entity. In terms of applying for student loans, you're probably all pretty familiar with this process. But basically, each year you want to fill out your FAFSA on the student aid website. Each year it opens on October 1st for the following financial school year. So whenever you fill it out, you're going to be given an estimated award amount in probably June of the year, or prior to the academic year that the funding is going to be available. And you don't have to accept the full amount that they offer to you. So it may be determined that you're eligible to take out $25,000 of student loans for a year of your master's program, but you may only really need 10,000 of those dollars, all right? So only take out what you actually need, because if you take out the full 25,000, not only are you going to have to pay all that back, obviously, but you're going to be accumulating interest on $25,000 instead of the $10,000 that you really only needed to take out. And then also you can submit a change in aid request form to determine which semester your loans get dispersed. So typically if you were to accept a loan of, let's say, $10,000, you would get $5,000 in the fall and $5,000 in the spring. But let's say you're on a 10-month assistantship and you don't really need the funds during the fall and the spring. What you really need is to have those $10,000 available to you in the summer when you're not earning an assistantship and you still have to pay rent and fees and books and tuition and all that kind of stuff. And so you can request that the $10,000 gets dispersed to you in May at the beginning of the summer semester, rather than being dispersed $5,000 in the fall, $5,000 in the spring. And the reason why this would be smart is because when it's dispersed in the fall and spring, you're going to be accumulating interest on those dollars all the way up until the summer when you actually need to use the funds, whereas you could just have the funds dispersed in the summer and avoid that interest from the school year. Just real quick, in terms of definitions, I want to go over the difference between the lender and the loan servicer. So whenever you take out federal student loans, the lender is the U.S. Department of Education, right? So they're the ones that made the initial loan to you. But the U.S. Department of Education doesn't have the time to keep track of your loan and make sure they collect your payments and make sure if you're in the right repayment plan and answer all your questions and all that kind of stuff. So they kind of farm out to these different loan servicing companies. And these companies are responsible for the customer service element of maintaining your loans, right? So they're the ones that you would contact to enroll in a certain repayment plan or to manage your payments or, ask any of those types of questions. So here's the list of the different loan servicing companies that they use. So I just want you to be aware of this, because when you look at your credit report or something like that, it might say Nelnet student loan, and you're thinking, Nelnet? I never borrowed from Nelnet. Did my federal loans get sold to some private entity and now they're private student loans? Like, don't worry, they haven't been sold to a private entity. It's just a loan servicer that's managing your loans. They're still considered federal student loans, and you still have access to all the provisions of student loans, of federal student loans. So just want to clarify, the loan servicer is going to be something different than the Department of Education, but it's still a federal loan. So when does repayment start? For Stafford loans, there's a grace period. So it's like 6 months for undergrad student loans, for example. So once you graduate, let's say you aren't able to get a job yet, and so you don't want to start making payments on your student loans, well, you get this grace period of 6 months where you don't have to make any payments. After that 6 months, that's when you're going to have to start making payments. With PLUS loans, as soon as your loan is dispersed to you, technically, you're required to start making payments. But the reason why you're probably not making payments is because there's something called deferment, which you can apply for, which postpones your payments till after you graduate. And one of the qualifying eligibility requirements for deferment, one of those options is being enrolled in school. So if you're enrolled in school, you qualify for deferment. You don't have to make payments, but interest is accumulating during that deferment time. How much will you need to pay on your repayment? Well, that totally depends. It depends on the type of the loan, how much money you borrowed, what the interest rate is, and what repayment plan you choose. So in terms of repayment plans, you've got the standard repayment plan, which we've talked about. It's a 10-year plan, fixed payments every month for 10 years. After 10 years, the student loan will be completely paid off, right? This is the most aggressive plan that you would ever be required to pay. The graduated repayment plan is also a 10-year plan, but it kind of stair steps up its payments, with payments starting lower than the standard plan at the beginning. Then after 2 years of making that lower payment, it kind of steps up. You make that new payment for 2 years, it steps up. Make that new payment for 2 years, steps up, until you've been making payments for 10 years and your loan will be gone after those 10 years. So that's good for people who maybe don't have quite enough income when they first get out of school to afford the standard repayment plan, but they still want to be on a 10-year plan, and they anticipate their salary will increase, and so they want to kind of start low and get higher as they go. An extended repayment plan gives you a fixed payment every single month for the entire loan term, but you can extend the loan term beyond 10 years. So you could have a 15-year term loan, 20-year, 25-year, 30-year, and then that, the longer the term, the lower your monthly payments will be, but then also the longer the term, the more interest you're going to be paying on the loan. Right? So kind of going back to that chart we looked at before, the extended repayment plan would basically be spreading the payments out over a long period of time in order to decrease each monthly payment. Income-driven repayment plans are similar to extended repayment plans in the sense that they spread your payments out over a long period of time, but there's not necessarily a fixed loan term. Instead, the amount that you pay each month is based on what your income is for that year and how your level of income compares to the amount of student loan debt you have remaining. And there's kind of this calculation that they perform that calculates what your monthly payment is going to be for that year based on kind of your financial data for that year. And then each year you have to recertify your income and report to your loan servicer what your income is, and then they'll recalculate what the appropriate monthly payment would be based on your income for that year. So each of these repayment plans, income-driven repayment plans, have kind of slightly different rules and considerations, but conceptually they're all the same in that the payments are based on your income. Now let's talk a little bit about the Public Service Loan Forgiveness Program. It's something that you've probably heard about in the news. It's a 10-year forgiveness program that allows you to make payments on your loans at a lower rate, basically income-driven repayment plan for 10 years. And then after those 10 years, the remaining balance on your student loans is completely forgiven. Now, the reason why you've actually probably heard about it a lot in the news is because a lot of people who thought they were making payments towards this forgiveness program, who then applied for forgiveness after 10 years, were denied forgiveness, right? I think only about maybe 10% of people who thought they were in the program actually ended up receiving forgiveness of their student loans in 2017, which was the first year that people could actually apply for forgiveness on their loans. So it's very important that if you're going to go for this forgiveness program, that you really understand the rules and requirements that are necessary in order to receive forgiveness. So let's walk through what those rules are. First, you have to have an eligible type of loan. All right, the loan must be a federal direct loan. So if you have FFEL loans or Perkins loans, they do not qualify for public service loan forgiveness. And the only way you can make them qualify is by consolidating them into a direct consolidation loan. If you have private loans, you're not eligible for public service loan forgiveness. The second requirement is that you work full-time for a qualifying employer. Now, the definition of full-time is the greater of 30 hours or your employer's definition of full-time. So let's say your employer defines full-time as 28 hours a week. Well, you would not be considered full-time for the public service loan forgiveness because your employer's definition of full-time at 28 hours a week is less than the minimum hour requirement of 30 hours. All right, and then likewise, even if you worked 30 hours for your employer, if your employer considered full-time as working 40 hours and you only worked 30 hours, you would not qualify as a full-time employee for public service loan forgiveness because even though you work 30 hours a week, you have to fulfill the greater of 30 hours a week or your employer's definition, and your employer defines full-time as 40 hours. So basically the way you can think about this is your employer has to define you as full-time, and that full-time definition has to be at least 30 hours. Right? So if you're a resident working 60 hours a week and the employer doesn't define you as a full-time employee, you don't qualify for public service loan forgiveness while you're a resident. And then the second part of this is the qualifying employer. So the employer you're working for has to be government related. So working for federal government, state governments, that's like public schools, any other kind of public services that are either federal or state level. If you work for a not-for-profit 501c3 or other not-for-profit public services like emergency services, military, law enforcement, etc. So the whole point here is just it can't be a for-profit private entity. So if you're a nurse in the ER and you work for a private hospital, you would not qualify for public service loan forgiveness. But if you're a nurse in the ER at a local hospital that's not for profit or government owned or something like that, then you would qualify for public service loan forgiveness. So the way that you're going to determine your eligibility for this bullet point, full-time employment for a qualifying employer, is that you're going to submit a form called the employment certification form. You can find it on Google. And what you're going to do is you're going to fill out that employment certification form with all of your information, and you're going to submit it to your employer, usually someone in the payroll department or human resources department, and someone in that office will be able to basically sign off saying whether or not you're a full-time employee and whether or not they are a qualifying employer. If they sign off on that, you take that form and you submit it online at the student aid site, or you mail it to whatever mailing address is indicated on the form. And when you mail that in, all your student loans will transfer from your current loan servicer to Fed loan servicing. Okay? And once your loans are with Fed loan servicing, that's when you're kind of considered like in the program, right? And then every single year, you're going to want to resubmit that employment certification form. Even if you're working for the same employer, I would recommend just continue to resubmit that form every single year just to make sure, 100% that your payments are being counted as qualifying payments while you're working for that employer. And then of course, every time you change employers, you definitely want to fill out that ECF form to make sure that your payments are being counted towards public service loan forgiveness. All right, so then once you've kind of considered those things and checked those eligibility requirements off, the next one is you have to make 120 qualifying monthly payments. So basically 10 years worth of monthly payments. Those payments have to be on time. The payments don't have to be consecutive. So you could work for a qualifying employer for 5 years and then take a break and then come back and work for a qualifying employer for another 5 years, and you could still get those 120 payments. They don't have to be back to back to back to back to back. And then an important note is that if you consolidate your loans at any point during the 10-year process, you will completely lose your payment history and restart the payment clock. So do not consolidate your loans. The only time you should consolidate your loans is if you have FFEL loans or Perkins loans and they need to be consolidated at the very beginning in order to qualify you for public service loan forgiveness. But once you've started making qualifying payments, never consolidate your loans or you will lose your history of payments. And then fourth, those payments have to be made on a qualifying repayment plan. So all of the income-driven repayment plans are considered qualifying repayment plans. So you have to be in an income-driven repayment plan. That includes the pay as you earn, income-based repayment, income contingent repayment. So those are kind of your options for the income-driven repayment plans. And all the requirement is that the majority of those 120 payments have to be made on an income-driven repayment plan. So let's say you started working for an employer, you didn't realize that you were eligible for public service loan forgiveness, so you just started making your payments on the 10-year repayment plan, and then a year into it, you realized, oh, I qualify for PSLF, so I'm gonna switch into an income-driven repayment plan, start making my payments. All the first year payments you made on the standard repayment plan, they would actually count towards the 120 qualifying monthly payments, as long as the majority or more than 50% of the payments are made on an income-driven repayment plan, you should be okay. But those non-income-driven repayment plan payments, in order for them to actually count, those payments have to be equal to or greater to the amount you would be required to pay on the 10-year repayment plan. All right, so you could not have been in an extended repayment plan for a year and then switch into income-driven repayment plan and count that first year payments. You would not be able to do that because on an extended repayment plan, your monthly payments would be less than what you would have to pay on the 10-year standard plan. So those payments would not count. Now, you can do a little more research because with all the confusion around receiving forgiveness and stuff, there is kind of a window of time when the Department of Education is allowing a little more flexibility in what types of payments they're going to count as qualifying payments because of just how confusing this program has been. So even if you have made some payments on an extended payment plan or a graduated repayment plan, it may be worth looking into whether you can get those payments to count towards PSLF, just because they are being a little more flexible for a period of time because of all the confusion around getting loans actually forgiven. Now, this chart just kind of breaks down a little bit of the difference between the varying income-driven repayment plans. Basically, what I just want to point out here is that some of the repayment plans, in order to qualify for them, you have to have what's considered high debt relative to your income, whereas some of the others, like the Repay or ICR, any income will allow you to enroll in the income-driven repayment plan. Just note that if you have a really high income and you don't have that much student loan debt, if you enter the Repay program, the calculated payment on your student loan could end up being higher than what you would be asked to pay on the standard repayment plan. So then it would not be even worth enrolling in public service loan forgiveness because you're going to end up paying off the loans faster than 10 years anyway. There's going to be nothing left to forgive. Now, one big drawback to enrolling in PSLF and opting into income-driven repayment plan is that it's possible your payments will be so low that you might not even be covering the interest that's accumulating on your student loans. So your student loan balance could actually be growing for the 10 years you're making payments and not reducing at all if you're making interest only payments based on your income. So that can be a little bit scary. So one kind of fortunate safety net that's available is kind of this safety net layer of forgiveness that's associated with income-driven repayment plans, even if you don't qualify for PSLF. So let's say you start on these repayment plans, you make payments for 10 years, and then for some reason you don't end up getting PSLF. Well, if you continue making payments till 20 years or 25 years, then you can still have the balance of your student loans forgiven. It's just that the amount that gets forgiven in that instance becomes taxable to you. So if you had $50,000 forgiven, you'd have to count $50,000 of taxable income. You know, if your tax brackets 22%, 24%, you'd be paying taxes 22% on $50,000, right? So you'd want to make sure to save up for that tax bill. But it's helpful to know there's at least some layer of safety net for a secondary forgiveness option in the event that PSLF doesn't end up coming through for you. So I also just wanted to point out that there's a few other loan forgiveness and cancellation provisions out there. So there's some teacher loan forgiveness options or profession specific or state specific forgiveness programs. And then if the student loans you have are results of a kind of predatory lending situation or mostly associated with for-profit institutions, more of a predatory, you know, school enrollment issue or something, or if the school that you attended closed or something like that, kind of these more rare situations, then there may be some options for cancellation or discharge of the student loans. And then I just wanted to provide here a few calculators that are available online. These are super helpful to evaluate kind of the comparison between different income-driven plans, whether or not PSLF might be worthwhile for you, and what, you know, even just calculating what student loan payment you can anticipate once you graduate on the standard repayment plan. So those are kind of resources to you to help you out in calculating what to expect from your student loans. So what if you're having trouble paying on your student loans? Well, there's a couple options, one of which is deferment. And deferment is basically a temporary postponement of making payments on your student loans for some qualified reason. Those reasons might be that you're enrolled in school, might be that you're unemployed, that you're facing an economic hardship, that you're in the military, you're being deployed, and there's kind of a list of eligible circumstances that would allow you to defer your loans. When you're in deferment, interest does not accrue on subsidized loans, but it does accrue on unsubsidized loans. And there's a 3-year limit for deferment for any of those reasons, except for being enrolled in school. There's kind of indefinite eligibility for when you're enrolled in school. Forbearance is similar to deferment, where basically your payments are temporarily suspended or reduced due to financial hardships. And these hardships are a little more subjective, so you would have to apply for forbearance and then, you know, wait to see whether or not your circumstance is approved or not for forbearance. Whereas with deferment, if you can prove that you're enrolled half time, you know, at least half time, or you can prove that you're unemployed or whatever, you kind of automatically qualify for deferment. So it's a little more objective whether or not you'll get approved. Whereas forbearance, you may or may not get approved. And when you're in forbearance, regardless of whether your loans are subsidized or unsubsidized, interest will accrue on your loans. And then what happens if you default on your loans? So you miss payments, you're unable to afford them, so you just ignore it and you don't make payments, then all of a sudden you find out you're in default on your student loans. So your credit score, you know, has gone down, it's showing up on your credit report. How can you get out of default? Well, there's one option, which is rehabilitation, which is when you make 9 consecutive voluntary, reasonable, affordable payments. And so what you would do is basically call up your loan servicer, you tell them your situation. Let's say you're required to make $500 a month payment on your plan and you can't do that, and so you negotiate with them and you say, okay, I cannot do $500 a month, but I could work out $350 a month. And then if they agree to that, then you make 9 consecutive on-time payments of $350, and then they will lift you out of the default status and then kind of continue from there. The second option is consolidation, which is when you make 3 consecutive voluntary full monthly payments on the defaulted loan, and then you agree to consolidate your loans and pay on an income-driven repayment plan. So let's say again that $500 a month, if you're able to somehow figure out how to come up with that $500 for 3 consecutive months, and then you consolidate your loans and get enrolled in an income-driven repayment plan, then they'll lift you out of default. Now, just a little bit on private student loans. As I kind of insinuated so far, federal student loans are definitely going to be your better option and what you want to do in most situations. So try to avoid private student loans if possible. And the reason for that is basically just that they don't offer the same options and protections that are offered for federal student loans. But there may be a circumstance when you need to take out private student loans. So if you do, that's fine. And when it comes to the repayment strategy for those loans, basically, your only strategy really is to look to see if you can find a private loan with a lower interest rate and refinance that private loan into another private loan with a lower interest rate in order to save you money that way. If you're having trouble paying on a private student loan, you can basically just look at the loan terms to see if your lender has any options for relief, but you're not going to have the same access to deferment and forbearance like you would with federal student loans. Now, the good thing about private student loans is that the collection powers are not quite as strong as they are for federal student loans. So if you miss payments on your federal student loans, then eventually they could start garnishing your wages or taking your tax returns or something. Whereas private student loans, there's not really any collection powers. It's an unsecured debt, and it would just impact your credit score. You'd accumulate interest, but they can't necessarily seize any of your property or your paychecks or anything. So when would refinancing your student loans be a good idea? First of all, when you already have private student loans. So anytime you refinance a loan, that basically means you're turning the loan into a private loan. So if you already have private loans, then it may be worth refinancing if you can find a new private loan that has a low interest rate. If you have federal student loans, then generally you don't want to refinance because you're going to lose your access to repayment plans, deferment, forbearance, all these kind of provisions for, PSLF. So the only time you would really want to refinance your federal loans is if you're willing to forfeit all the protections of having a federal loan and the interest rates available for private refinancing are significantly lower than your federal rates. So let's say you have, a grad school loan that's at 7% and you're going to work for a private employer, you don't qualify for public service loan forgiveness, refinance your federal student loans into private student loans. So kind of going back to what I said at the beginning, the best option for one person when it comes to paying off student loans is not going to be the best option for another. Everyone's situation is different, and you have to kind of think about the intersectionality of the amount of student loan debt you have, your eligibility for different repayment and forgiveness programs, the type of profession that you're going into, how long you're going to work, and then just personal preference about your aversion to debt and whether or not you can handle this idea of debt. So you want to be thinking about these things. So with eligibility, the type of things you're thinking about is what kind of loan do I have? When were they dispersed? What kind of programs are they eligible for? What kind of repayment plans are they eligible for? Amount owed, what's the monthly payment going to be? What's the interest rate? Is it something where it's worth refinancing? Is it not worth refinancing? Can I afford the monthly payment? Can I not afford the monthly payment? Can I afford the monthly payment, but in doing so, I wouldn't be allowed to pay off my other high interest debt? If so, do I need to think about switching into a repayment plan that allows me to, kind of refunnel extra cash toward high interest debt? Right? When you're thinking about the profession, is this a long-term career choice? Am I comfortable spreading my loan payments over a long period of time because I know I'll have income for a long period of time? Or do I think it's possible I could only be working for the next 10 years, and so I should use as much of my income now to get rid of these student loans as quickly as possible. Do I qualify for loan forgiveness with my profession? And then personal. So, if you're super debt averse, even if you qualify for public service loan forgiveness, you might not want to do it because you might just want to pay off your student loans as quickly as possible in the next 3 to 4 years, right? Just to get rid of the debt. But if you don't feel super stressed by having debt and you're okay with letting it, linger for 10 years in order to get the most bang out of your buck and get that forgiveness, then, it might be worth holding on to them for the 10 years in order to get the forgiveness. So you just want to think about how can you optimize your net worth, and then based on that scenario, personally, can you handle what that means in terms of how long you're going to hold on to your debt. And then just as a reminder, lowering your monthly payments is only a good idea if it's what you need to do in order to basically survive or pay the rent, or if by lowering the payment it allows you to pay off high interest debt, if it allows you to meet retirement savings thresholds, so saving at least 10% of your income, or if it leads to total loan forgiveness. So here's just a few more resources. The Department of Education Student Aid site is the best place to get reliable information about federal student loans. If you want any information about UGA's financial aid process, there's the website there. And then FinAid, Ask Heather Jarvis, and Student Loan Hero, those are just some additional resources that have calculators and blog posts and kind of some strategies that you can think about. Just kind of take some of those blog posts with a grain of salt, but they do have a lot of helpful resources out there. All right, so that's it that we have for the student loans presentation. So if you have any questions, feel free to reach out to us at the Graduate Financial Education Program, and we'd be happy to help answer any questions you may have. If you are a student on the UGA campus and you want to have kind of a one-on-one consultation with somebody about your finances, you can reach out to the Aspire Clinic, and they take appointments for one-on-one financial counseling, and that is a completely free resource to you.